You never want to be forced to do anything. And the worst thing you can do is put yourself in a position to be a forced seller of stocks. Because someone who is forced to sell stocks at inopportune times may not only not make big investment gains, but may actually sell at the worst possible times. Now, I want to start with a quick story. Imagine you were an investor during the Great Recession in 2008 to 2009. You would have witnessed your stock portfolio drop by over 50%. And so what that means is you would have seen your net worth cut in half. Now that is very painful to endure. And it is very common for someone to get emotional in that moment and say, I cannot take any more pain, I just want out. Now, part of this has to do with a psychological bias called loss aversion. The idea behind loss aversion is that we are much more sensitive to losses than gains. And so if you were to tell someone to flip a coin, and if you were to get the answer right, we'll give you $100, and if you get it wrong, you will lose $100, most people will not want to take that deal because the idea of losing $100 is way too painful. Now, in that circumstance, there's nothing actually wrong with that because being loss averse means that you're protecting your downside. And it is important to be aware that once you lose money, it is much harder to make it back than it is to not lose it in the first case. And so for a simple example, if you lost 50%, you would have to make 100% to get back to even. Now, the problem with loss aversion during the Great Recession, though, was that this was not a sort of rational loss aversion. In our coin flip example, the odds may have been you can gain $1,000 and only lose 50. And so when you are in a scenario where there's such an asymmetric payoff, it does not make sense to be as loss averse. Now, what these poor investors did during the financial crash is many of them sold out of all of their stocks. And they were doing so thinking that they would be able to cut their losses now and get back in a better time when things are safer. Now, you have to understand that this is a classic lie that investors have been telling themselves forever. Whenever there's a significant drawdown in the stock market and there's more uncertainty, investors always tell themselves that the skies will be clear later on and they will be able to get back in. Now, these investors, though, that sold at this moment would have missed a 50% increase in stock prices over the next year. And at that point, they would have been thinking, well, now I need to wait for a setback because I missed the rally and I can't enter now. And thinking such things would have meant that they missed out on another 75% rally up until 2015. And at that point, these investors would have felt like, well, now I missed the entire rally. I need to sit back and wait until there's a pullback so I can enter again. And thinking such things would have meant that they missed another 60% increase in stock prices until right before the COVID crash. Now, you may be thinking, well, the COVID crash, that would have been the perfect opportunity for them to get back in because stocks fell 30%. However, the sort of investor that has this kind of mentality at this moment would have once again made the same mistake they made during the 2008-2009 financial crash, which was to think, oh, the skies will be clear later on. Now there's real uncertainty with the COVID pandemic. I've been waiting this whole time. I need to wait until things are clear again. And then they would have missed another subsequent rally. In fact, if they had just stayed invested, even from the peak right before the financial crash, they would have still had a return of over 3x. That is a return of over 300%. And so it is really important as an investor to understand two things. One, the best opportunities to invest tend to be when there is the most uncertainty. And that is because the market prices in a lot of uncertainty ahead of time, especially because of loss aversion. And as we mentioned, many investors get very emotional when there's not just uncertainty, but they see their portfolios go down and they just want to stop the pain. And so they sell their stocks, which causes the stock market to drop even more. And in such moments, it generally tends to be a good opportunity to take advantage of the situation. Now, just to put some numbers on how common stock drawdowns are, in about 9 out of every 10 years, the stock market is going to drop at least 5%. Now, for many people, that may not be that much, but some people do still get freaked out in such scenarios, Where you personally will start to get emotional and fearful will depend on how well you understand your companies and also the stock market history. And so a correction, which is when the stock market drops 10% or more, tends to happen 1 out of every 2 years. And so that too is pretty common. Now, a bear market, which has a loose definition of the stock market drawing down more than 20%, tends to happen every 5 to 6 years. Now, if a bear market is accompanied by a recession, it tends to take 1 to 2 years for the stock market to fully recover. If there's no recession, it could be as little as 6 to 9 months. Now, these, though, are just average facts of what have been observed in the past. Of course, every instance is going to be different. And this is why it is such an important thing as an investor to not lose your emotional cool. Because people who look at history and look at these averages may not only fool themselves into thinking the future will be the same as the past, they also will tend to argue about why this time is different. Now, those two things may seem like they're conflicting, but in reality, they still drive an investor to the same sort of decision point, which is to not want to own equities at this moment. Generally speaking, though, the longer term your time horizon, the better it is to own stocks versus almost any other asset class. Jeremy Siegel, professor at Wharton, had a book called Stocks for the Long Run. And what he found was that on no 20-year period, going back to before the Great Depression, has any investor ever lost money. And that includes even accounting for inflation. And so in other words, if you have a 20-year time frame, there's little chance that you will actually end up losing money, at least according to history. But sometimes it could actually be worse than just a 20% drawdown. During COVID, stocks fell 30%. During the financial crisis, as we mentioned, they fell 50%. During the tech bubble, the tech index, which is the NASDAQ, fell 80%. And so things could get much worse. However, if you have a long-term time horizon as an investor, things historically have always worked out. If we are going back over 100 years, stocks have returned 9 to 10% on average. Now, the reason why they return so much more than other assets like bonds, commodity, gold, currencies, is because of this volatility, is because as an investor, it is emotionally hard to live through these periods. And so you could almost think of this volatility, this emotional pain of having to deal with watching your portfolio drop in value so much, as a sort of fee that you pay in order to get these higher returns over time. And so as an investor, it is really important to understand what the long-term picture of stocks has been historically. And if you still, though, are a little unclear on how to emotionally handle yourself during such a situation, check out this video here.